So a listed investment trust, like an unlisted trust, is a pooled investment vehicle managed by a professional manager, giving investors access to a diversified managed portfolio. The key difference is it's listed on the ASX, so that's the predominant means of access, trading shares on the secondary market. But the key difference is it's closed-ended, so initially funds are raised through an initial public offering, and once those funds are raised, that's it for the trust, and then units in the trust are then traded by investors on the ASX, rather than new units being created relating to funds inflows. So a listed investment trust is very similar to an investment company in the way that it's accessed and traded on the ASX. The key difference, though, there's two. One is the way that it's taxed within the vehicle, and secondly, it's the way distributions or dividends are made. So firstly, on taxation, a listed investment trust is like an unlisted managed fund in that it's tax transparent. Any realised capital gains or underlying income of the fund is distributed through to investors. That includes the underlying franking credits of the investments in the fund, and then the investor is responsible for paying taxation at their rate on that distribution. Within a listed investment company, under a corporate structure, the income and capital gains made within the company are then taxed at the company tax rate. So what that enables them to do is to pay a dividend out of profits, and because tax is being paid, that's fully franked. So that can be an attraction for investors because they get a certainty around the level of tax that they'll need to pay. A disadvantage to that can be that under the company structure, it may not be eligible for capital gains tax discounts. Certain LICs do get that concession if they have a buy and hold type strategy, but an actively, sort of a highly active trading LIC generally won't get that concession for investors. The other key difference between the listed investment trust and company structure is the way distributions or dividends are made. So like a unlisted fund, the trust distributes all realised capital gains or underlying investments, and the manager also has some discretion over how much they can pay out each year, and can set sort of a target distribution as long as they're paying out all returns. That differs to a listed investment company, which can only pay out of profits or retain profits. And generally what a listed investment company will do is build up a profit reserve buffer so they can pay a smooth stream of dividends over time. The risk is, though, that works during a period of rising, appreciating markets, because that profit reserve can grow. But the risk is if markets decline, that profit reserve buffer can be eaten into, and a listed investment company may need to cut dividends for a period of time until they can replenish that. And that's what we saw during the GFC. So while there can be smoother dividends in a listed investment company, they can be restricted at times in paying dividends, whereas a trust can have more discretion during those periods to pay out of capital. Like a listed investment company, a listed investment trust has a fixed number of units or shares trading on the ASX, and then the price that trades at can differ from the underlying net tangible assets of the fund, depending on liquidity of the trust and just general demand and supply of the trading of shares at any particular point of time. So as with listed investment companies, they can trade at premiums or discounts, sometimes a significant premium or discount to the NTA of the fund. Those premiums or discounts in particular can widen during times of market stress. So that's unlike an unlisted fund that creates units or cancels units as funds flows comes in. So that's the biggest concern for investors. There's currently a handful of listed investment trusts. The market is this part of the market is dominated by the investment company structure rather than trusts. But in the last 12 months, we've seen Forager converted their unlisted fund to a listed investment trust structure to have that fund be captive. And we've also seen Evans & Partners come to market in June with a raising this year. And now we've seen the announcement from Magellan Global. They're pursuing the trust structure. So the market is only growing from here.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.